Audit Limited initiated a high-risk market pivot, raising the retail price of their toys by 15% to signal a premium brand to consumers. Alongside this price hike, management diverted capital into a large bulk order of a new line of special toys, purchased while they still held significant stock of their existing standard inventory. According to their financial reporting, this dual strategy resulted in significant growth and a volume-driven spike in revenue. However, basic microeconomics dictates that raising prices on discretionary goods typically suppresses sales volume. Audit's reported financials appear to contradict the expected economic outcome of their pricing strategy. Under International Standard on Auditing 315, our task is not simply to verify the arithmetic. We must determine if the reported numbers align with the physical reality of the business environment. This document contains the specific operational and financial data points required to perform that analysis. Management provides their qualitative narrative in the second paragraph, detailing the 15% price increase and the introduction of the new products. We then look at the quantitative data. Reported credit sales increased from 4 million to 5.4 million in a single year. When a company's reported performance diverges from the expected economic results of their business environment, an auditor must assess a high risk of material misstatement. Look closely at the phrasing at the end of the narrative, in anticipation that sales would increase. This narrative justification invites the reader to accept the 5.4 million revenue figure as a successful outcome of the business strategy, rather than interrogating the underlying volume. By applying analytical procedures, we establish a baseline expectation. We take the prior year's revenue of 4 million and add the 15% price hike to reach an expected 4.6 million. Comparing that baseline against the 5.4 million reported revenue reveals an unexplained 800,000 variance. Because the price increase is already accounted for in our baseline, this extra 800,000 represents a substantial surge in the actual quantity of toys sold. This surge occurs despite a 15% price hike, which typically lowers demand. A massive increase in physical volume under these conditions lacks a logical economic explanation. The solution notes support this deduction, clarifying that the additional revenue relates to a quantity increase that is unlikely to have occurred. This volume variance indicates a high risk of overstatement of revenue, specifically targeting the occurrence assertion. We move to the balance sheet to observe the cash flow related to these sales. Accounts receivable increased from approximately 383,000 to nearly 822,000. To understand the implications of this increase, we must calculate the receivable days to determine the actual speed of cash collection. The calculation shows that collection speed slowed from 35 days in the prior year to 55 days in the current year. It is now taking the company 20 days longer to collect cash, a trend that contradicts the narrative of a successful premium product launch. If the new premium toys are highly sought after, there should be no immediate logical reason for the company to struggle with customer payments. One possibility is that management relaxed credit terms to force that $800,000 in volume onto distributors. Alternatively, if the $800,000 in additional sales are fictitious, there are no real customers to pay the resulting invoices. The solution document identifies this as a risk of overstatement of receivables and an understatement of bad debt expense. A 20-day increase in collection time during a premium price hike signals a risk to the valuation assertion for both receivables and bad debt expenses. We now examine the final component of working capital to observe the activity within the company's warehouses. The inventory balance rose from roughly 137,000 to over 231,000. Calculating inventory turnover days shows a 10-day increase, moving from 25 days in the prior year to 35 days in 2023. This warehouse slowdown correlates with management's decision to purchase a bulk order of special toys while still holding stock of the ongoing toys. This creates the risk of product cannibalization, where new, more attractive inventory reduces the demand for older models. If consumer demand shifts exclusively to the new special toys, the older ongoing toys may cease to sell. This legacy stock essentially becomes dead stock, which explains why the company is holding inventory for an additional 10 days on average. Under IAS 2, if this inventory cannot be sold at its original price, its net realizable value has likely fallen below its cost. The solution notes confirm this risk, noting that old inventory residing in the warehouse points to potential understatement of NRV losses. This represents a direct threat to the valuation assertion for inventory. Introducing new products while holding old ones creates a significant risk of product cannibalization. Failing to record the resulting NRV losses leads to an overstatement of inventory. This analysis demonstrates that quantitative financial figures must be reconcilable with the qualitative business narrative. To derive audit risks from operational changes during an exam, you can apply the PIE framework. P stands for price. Price hikes typically suppress volume. If revenue increases despite a price hike, analyze the occurrence of the sales quantity. I stands for innovation. Introducing new product lines often devalues legacy inventory. Always assess the valuation of old stock for potential NRV write-downs. E stands for extended days. A spike in receivable or inventory days often contradicts a narrative of growth, pointing to potential valuation issues in both accounts. Success in auditing exams requires moving beyond mechanical calculations to interrogate the business model as a lead auditor would.